Hello, everyone. I'm so excited to be interviewing Mike, the author of Dividend Guide blog and Dividend Monk, and is the portfolio manager of Dividend Stocks Rock. Now, Mike is a passionate investor who decided to leave his corporate life in the traditional financial world and live life fully on his own terms. So I'm so excited to interview Mike and cover the Canadian stock market. What are the three opportunities in the Canadian stock market right now? How does Mike manage his stock portfolio and sleep soundly at night? And what are Mike's top five holdings in his stock portfolio? So if you are a Canadian investor that loves building a lifetime of passive income in the Canadian stock market, then you definitely want to check out today's video. Talk about the Canadian stock market. So, given what we're seeing right now, is there a lot of opportunity right now in the Canadian market? Are you seeing some solid plays in sectors or that look attractive to you?
Yeah, actually, it's kind of interesting because if you look at the difference between the US market and the Canadian market, we had like the US market greatly outperform the Canadian one for the past 10 years. So today it's a little bit harder to find those opportunities. So right now we can see like sometimes like the tech stocks are dropping, but it's not still amazing deals. You're just getting like the deals of like December or November of 2021. So it's not like crazy. But when you look at the Canadian market, you have some great opportunities right now. And one of them is, and this is fascinating, but Canadian banks right now, they're not trading at a very high P ratio compared to the past 5 years. So it's not like some people, they would just like use valuation as their metric to buy. I use it really at the end of my investment process, mostly to just make a difference between like two or three stocks from the same sector that I like. And then if one is trading at a lower P, I may get a little bit more attention, but I like to see how the market has valued the stocks over the past 5 or 10 years. So that gives me an idea that on general, Canadian banks P ratio should be between 10 and 12. So whenever the market is hype and you reach 13 or 13.5 or 14, then you can say, oh, I might be buying Canadian banks at a higher value right now. So I might have to stick to the dividend for a few years and not see the stock price goes up and just plateau because it's a little bit overvalued. Right now, we are in that place where most of them are trading around 11 P ratio, 11 times their earnings, which is not that crazy, especially when you're thinking that they're going to make more money out of interest rates. And they're also going to continue making money from the other business segment that I've discussed earlier, such as capital market, wealth management, and insurance business. So they're using their oligopoly situation. So they're all, it's like a country club. They're 5, 6 and playing in their playground. So they're comfortable. Everybody has their market share. They're making money, and then they're going outside. So TD is going in the US. National Bank, I bought a bank in Cambodia. Scotiabank is quite international. BMO is going for ETF and more capital markets. So they have all their little ways to generate more income. So that would be the first place that I would look at. My favorite one is National Bank, mostly because they have about 50% of their revenue generated from the classic savings and loans. But the other half is coming from those other growth vectors. And moving forward in the next 10 years, a lot of money will be made from wealth management. Why? Because we have all the boomers that will transfer that money to the new generation. And that brings a lot of questions. That brings a lot of companies being sold, also be acquired. And you need people that are able to pay for to give advice, and people are willing to pay for them, especially if you're like your father has like this company generating like $50 million a year, and now he's about to sell it to you. You might want to be willing to pay for a few tips here and there to make sure that you pay the right taxes and that you invest accordingly, right? So that would be the first one. The second one would be Couche-Tard, Alimentation Couche-Tard, also known under Circle K, second largest convenience store in the world. Amazing business model, grow by acquisition. And now what is very interesting is they currently have a very healthy balance sheet. So meaning they are able now to drop billions of dollars on their next acquisition, and that will be perfectly fine. They can definitely swallow a huge chunk of the market. And what I like about their management team is that they are incredibly disciplined. So when the deal is not good in terms of price or in terms of assets, they do their due diligence and then they walk away if it's not worth it. They've done it a few times in the past, and that's why there's less hype around Couche-Tard right now, is because they haven't completed a major acquisition over the past 2 3 years, but they're ready for that. And in 2021, throughout their investors day, they said, you know what, 40% of our growth will come from mergers and acquisition, which is lower than what they used to be. But we have 60% that will be generated from organic growth. And from organic growth, they want to enter more technology. They have also, a lot of people are concerned because, they're making a lot of money selling fuel. And they're saying, yeah, but we're moving towards electric vehicles, so that's a big threat for them. But a lot of people forget that Couche-Tard has made major acquisition in Norway several years ago. So, and Norway is the country with the largest electric vehicle fleet. It's like 14% of all of their vehicle are electric. So they have their own laboratory right now. They're just like making tests and trying stuff, and they're actually making a lot of money because they install superchargers. So while you're charging your car, well, what do? You go in the convenience store, you grab a snack, you buy a few stuff, and then you come back to your car, it's fully charged, and then you move. And Couche-Tard has all those amazing locations, so it's going to be very easy for them just to transfer that. They have issued green bonds for that project. They want to bring those superchargers in North America. So we'll see how it develops. But I kind of like how management is looking into the future. They're just not saying, oh, we're going to, sell fuel and alcohol and cigarettes and chips and that's it, and we're going to let the business die. No, they're always trying to find a way to grow. So that would be my second idea. And my third one, if you look at renewable energy, there was a lot of hype in 2020 around them. They all skyrocketed and then they got smacked big time by the market. One of the most important reasons for that is a lot of money went from the oil and gas to renewable energy. And then they just said, oh, whoa, oil and gas market is making money again. So they just sold the renewables and they went back into the classic energy model. But if you're looking long term, we need more renewable energy, and companies like Algonquin Power and Brookfield Renewable, those businesses are well established. I like Algonquin because they're very aggressive in their merger and acquisition business model. They have been doing that for the past 10 years with great success. But at the same time, it's a little bit of a speculative play because they issue a lot of shares and they get into a lot of debts to finance their acquisition. So we're at the place right now that the market doesn't like it too much. We're getting to, and we're seeing that in general, we're getting to the end of that appetite for risk where the market says, hey, you're taking a little bit too much debt for my taste right now. So, you know what, I'm going to look at another company with lower debt level and stuff like that. But if you're patient enough, I mean, management proven that they're able to do that over and over again. And what they do is that they buy regulated utilities like they did with Kentucky Power not too long ago. And Kentucky Power generate most of their electricity from coal. So they will shut down the coal plants and they will shift it to wind farms and solar panels and all renewable energy. And they've been doing that, and they're very good at that greening process of utilities. So I think it would be a very interesting play. And obviously, since the stock has been beaten down, not trading at a very high value right now, offering a very interesting yield. So again, and all of those companies are obviously dividend growers. So you have to consider that as well.
I also want to touch on you worked in the private banking business for many years. Can you just like switch over to like what are the two biggest mistakes that you've seen investors do?
Yeah. So before running Dividend Stocks Rock, I was a certified financial planner and a private banker for 13 years. I had clients when 2008 happened. and when the oil bust happened in 2014, 2015 as well. So I went through some good times and some not so good times with my clients. And one of the first thing that I've noticed is um, this idea that you can, as a retail investor like you and me, that you can foresee the future and play a trend before anybody sees it. So people are instead of like sticking to their strategy, and that's the major mistakes. If you have an investing strategy and you understand it and you have a plan, just stick to it. Not trying to say, oh my God, okay, so right now it's the time to invest in gold. And then right now it's the time to invest in the oil and gas market. And right now it's the time to sell. And don't try to do that, because unfortunately you're not that smart, and I'm not that smart either. And it's impossible to be right all the time. And it only needs once that you make a mistake and you're actually wrong about the fact that you thought it would go up and it doesn't go up, and then your part of your retirement plan is in jeopardy. So stick to your strategy. And it's kind of funny because when I was in 2008, I had an important client that invested nearly $1 million with me, but in July of 2008, like literally like 3 weeks before Lehman Brothers goes bankrupt and all the thing crumble, you know. So the guy invests like almost $1 million with me, and then within 2 months he's down like 20%, and he's like, oh my God, what have you done with my money, you know? So we went back on the plan, we looked at it, I explained what was going on, and I was telling like, you know what, it sucks that it happened so fast, but it was expected, you know, with the type of investment you have, with the risk tolerance that you have, you're supposed, and you told me that 20% drop was great. It was good. Not great, obviously, but you can go through it, right? And and after reviewing everything, he decided to stick with the plan, didn't do anything, didn't panic sell. And 3, 4 years later, he called me back once, and then he said, you know what? Thanks to you. And he was, at first we were talking like every month or something like that, but he said, thanks to you and the fact that you keep me informed, I haven't done anything. And today I look at my portfolio, I look at my retirement plan, and you know what? I can do everything I want. So you were right. You know, it went up and it's all good. So the first one is not to stick to your strategy and try to like go after this shiny object. And the second one is actually the opposite, is to get so much information, so much time to analyze, that weeks go by, months go by, sometimes years go by, and nothing happened in your portfolio. So you suffer from paralysis by analysis. And today, if there's one thing that is bad about the internet, is the overweight of information. It's super easy to get information, but the problem is you can spend all day watching YouTube, listening to podcasts, reading articles, and at one point you're going to have like 50% of people telling you it's time to buy, and the other 50 telling you it's time to sell. So you're just like looking at your screen and you have no clue what to do. So it's important to cut down that noise and not get overwhelmed by information.
There's so much information. I could definitely feel like there is, yeah, it could be overwhelming. So, as for you, like, you talk about how it could be super overwhelming. Is this one of the reasons, or what are your reasons for starting, leaving the wealth management, investment banking business and then going into Dividend Stocks Rock?
So what happened is in 2016, I decided to take a sabbatical year. And then my wife and my 3 kids, we bought a small motorhome and we decided to drive across North America and then Central America. And we went away for a year. So it was just amazing, just, chilling by the beach, having fun with the kids and the wife. And at that time, I already had Dividend Stocks Rocks as a small membership website, but it was more like a sideline just for fun. And then I realized at that time that instead of being a private banker and helping like 300 people, I could go online, grow Dividend Stocks Rocks, and help thousands of investors. And what I realized throughout, because there's a bunch of people like me that has like financial backgrounds and information and a bunch of diplomas and so on, But the thing I realized throughout that trip is I have a lot of confidence. I didn't mind going into Honduras on foot. I mean, one of the, like the dilliest country in the world. And I was like confident that it was going to be all right. You know, I had the plan, I knew what I was doing, it was all fine. And then I realized a lot of investors lack of that confidence. They're confused, they're scared of making mistakes, and it's a normal sentiment. I mean, you don't want to play with your retirement. You don't want to lose hundreds of $1,000s. And we have so many horror stories that it's freak you out. So you get paralyzed, you get confused, and the market is making so much noise that it's almost impossible to figure out what's your next move. So by going full-time at Dividend Stocks Rocks, my main goal was to provide that confidence to my investors, to my members. And during the market crash of 2020, what I did is I always do private webinars for my members, but at that time I decided to do like almost a weekly webinar. So I did like 5 or 6 private webinars over the past over 2 months period between March and April, just to talk with them, you know, answer their question, talk about the economy, talk about what's happening and how you can position your portfolio, and how there's so many great businesses that will actually do well. I mean, you know, I was looking at my own businesses, my own stocks in my portfolio, and I was like, okay, so this company is generating power. Well, pandemic or not, we need electricity. Okay, this one is providing wireless services. Well, you know what? More than anything else now, we do need our cell phone. And then, oh, this one, oh, look at that. It's Microsoft. So they're helping people working from home. Yeah, well, I bet they're going to thrive during the pandemic. So it's not going to reflect on the stock price right away, but it is actually going to be a huge opportunity for them. And as I mentioned earlier, when stock price drop like this, it's actually a great opportunity to invest. But a lot of people, they freak out and they get overwhelmed by this noise. So the overall goal at Dividend Stocks Rocks is to simplify things, make them straightforward, you know, keep a simple strategy and cut down all that noise so you can invest with conviction and you can sleep well at night with that.
Perfect. Oh, that's so awesome. I love that. Love the simplicity. Simplicity, especially when you have kids and you have life and all that. And all right, let's hear it. So you did touch on, you know, the stocks that you were holding. What are your top three key, holdings in your portfolio, if you don't mind sharing?
Yeah, actually, if you go on the Dividend Guy blog, I share like all my pension plan portfolio, so you can like see most of my holdings there. So my 2 largest position are in the tech world. They are Apple and Microsoft. They actually grew that way because I like to have equally weighted position in my portfolio. But I mean, fortunately and unfortunately for me, those have just skyrocketed. So they're a lot larger now, but I'm trimming slowly but surely because I want to keep it a little bit lower. And then my 3rd largest position is Couche-Tard. So, and then we had like National Bank and TELUS that are not too far away before that. That would be my top 5.
Nice. Okay. So you're saying like you seem pretty disciplined. So you're saying that if it grows to a certain size and it goes beyond, I guess you're like you're a portfolio fund manager. You gotta trim it down back to the 15% position. It's a risk management strategy is what you're doing.
From my experience as a private banker where I had clients with large shares of a specific business, you know, because I was like dealing with people with $1 million and up as investment, you know, and it happened a few times. And once that I was like super proud of is before I went on my sabbatical, I convinced a family that inherited of shares from a founding members. And I told them, you know what, that's like that was like 40% of all their fortune was invested still in that stock. And I thought, you know, you might want to like sell those shares, reinvest it in a more diversified way. And while I was gone on that trip, the stock, they actually listened to me like a few months before I left. And while I was on that trip, I was still watching the stock market, obviously, and that company fell by like 50%. And I was like, oh my God, I just saved them like millions of dollars. So they should maybe write me a check or something. But yeah, so yeah, that's why. And it happened again in December. I sold a few shares of Apple and Microsoft just to do some rebalancing, not too much. But as you said, at one point, you don't want your entire plan to rely on 1 or 2 strong position in your portfolio. So it's fun to make money, but it's even better to keep it that way.
Mike, thank you so much for your generous knowledge. It's been so, so valuable. I just want to know, let people know where people can find you.
You can go to dividendstocksrock.com. That's my membership website, but we also offer a free workbook on it. It's like nearly like 40 pages where you're going to learn about sector allocation, which sector works best for you depending on your goals, how to determine how to invest in stocks, your buying process, selling process, and so on. It has like a bunch of questions to make you think about that as well. So it's like very well built for that. And we actually built it with my members to help them out. And then after that, it's like, oh, well, I can offer that to people so they can like start on their own and start their investing journey like with that empowerment. I also have a podcast, Dividend Guy Blog /podcast. So every Wednesday we have an episode on that. And actually we have an offer for all your listeners. So for Dividend Stocks Rocks, it's a membership website where you can access portfolio models. We have a newsletter, private webinars. We have like probably like the most complete dividend stock screener there is in North America, because we cover both Canadian and US dividend stocks, cover over like 1,100 companies with ratings and so on, graph analysis, everything you need to build your portfolio. And we're giving out a 33% discount, and that's a lifetime discount. So you have it this year, you have it next year, you have it in 5 years if you want, as long as you remain a member. So go to dividendstocksrock.com/FNM for financial Nirvana Mama. So we thought FNM was a little bit faster to put it. And the coupon code would be there. So it will be FNM 33. So you can either subscribe to the regular subscription where you have like everything that I've mentioned, or you go pro. So for dividend, for DSR Pro, which will enable you to build your portfolio on our platform, get our quarterly report on your portfolios. We have a team of analysts that will tell you, oh, you're overweight on this part. We have like a few stocks that we don't really like their earnings, so we're going to highlight them for you. So you won't have to track news anymore, and everything will be simplified for you. So again, dividendstocksrocks.com/FNM, and the coupon code, very easy to understand, FNM33.
Oh, thank you.